Welcome, everyone, to this week's live. This is Matt Sorensen, wealth lawyer, award-winning entrepreneur. Excited to be with you today. I've got a lot of questions in the hopper. People have already submitted in advance. Thanks for all of you that submitted those. No matter which medium you send it in on, we're going to hit those today. So the goal of today is I'm going to answer questions about retirement accounts. We'll get off that. Of course, you got tax, legal, wealth building, entrepreneurship, small business questions, real estate. I can field those too. If you want to know who's going to win in the NCAA tournament, don't ask me. I don't freaking know. I honestly thought the tournament was over. I guess it's still going. So last person you want to ask is me there. But seriously, that's my lane, is in the wealth building, tax, legal strategies. I've been an attorney for almost 20 years now. I can't believe it. In November, it'll be 20 years as a lawyer. Also founder, CEO of Directed IRA by Directed Trust Company, Inc. 5000 award-winning business. One of the fastest growing in America. We have 1.7 billion in assets. We just got started 5 years ago. So got a lot of other things I'm into, of course, but for today, just want to hang tight for a second here. We're going to let some people join. Then we're going to make an official start here in about 30 seconds, and I'm going to get into your questions. So if you have a question, please submit it. I'm going to hit about 3 or 4 initial questions that came in. And then we're going to start taking any live questions. We're going to give those priority. Any of you got live questions, particularly around retirement accounts, IRAs, 401ks, Roth accounts, anything retirement account related, I want to hit those. And then I probably got another 10 or 15 questions in addition to the first 3 that have already came in advance. I'll be hitting those as well too. So we're here every Monday, noon Pacific time, doing a live. And the point is to ask your questions, teach you about some topic that relates to building wealth. All right, let's get started. Welcome, everyone, to this week's live. My name is Matt Sorensen, wealth lawyer, award-winning entrepreneur. Excited to be with you today. Today's topic is retirement accounts. This is one of the key pillars to building wealth. When we think of people who have built wealth, and as a lawyer, I plan tons of people's estates where they come in and they've built these assets and they said, how do I give them away to my family, my loved ones, to charity? And one of the lessons I learned is, how did people actually build wealth? As a business and tax lawyer, I've just seen it. I've had the 10,000 consults with clients. There are 4 ways people build wealth: business ownership, real estate assets, retirement accounts, and other investment accounts, brokerage accounts, other investments like that. Those are the 4 pillars people use to build wealth. Now, we're going to be talking about one of those today, specifically retirement accounts. Happens to be one of my favorites. I like all 4 of those, but retirement accounts happens to be my expertise. And so there's $35 trillion in U.S. retirement accounts. There's more money there set aside as investable assets than any other place. And as Americans, we've been trained to save and invest our money there. There's tax benefits to it. You don't pay taxes as you're building that retirement account and investing in it. If it's a Roth account, it comes out totally tax-free. Your traditional accounts, you get tax incentives and deductions to put money in. Those are all these little perks and reasons to save in a retirement account. We can get at those if anyone has questions today, but I got a lot of specific questions that already came in about how to use retirement accounts to build wealth. So we're going to be talking about that specifically today. Now, I'm going to hit a few questions here that came in advance. I got maybe a dozen or so that came in advance, but I'll also prioritize any of you online here that have live questions. All right, let's jump right into it. I'm going to get to some of the questions that came in advance. And this was from Melissa Schmidt. She asked, when converting a traditional IRA, do you have the same yearly max limits that can be put into the Roth IRA? Or if it's over $7,500, can I convert the entire amount? Okay, so if you have a traditional IRA and you're like, I'd rather that be a Roth IRA, you can do what's called the Roth conversion. If that account is $200,000 of traditional IRA dollars, you can convert that whole $200,000 over to a Roth IRA. The $7,500, which would have been a 50-year plus contribution limit for 2023, it's $6,500 for 2023. You can do an extra $1,000, $7,500 2023 if you're 50 or older. For those of you looking at 2024, it's a $7,500 contribution plus an extra $1,000. So, or sorry, 7,000 plus an extra 1,000 up to 8,000. So, but that's your contribution. That's just how much you can put in each year as a new contribution of new dollars. The conversion amount, when you convert from traditional to Roth, there's no limit on that. If you want to convert $100, you could do $100. If you want to convert $1 million of traditional to Roth, you can convert the full million. So no restriction on that, Melissa. You can convert as much as you want. Now, remember, when you do a Roth conversion, the downside to that is that conversion is taxable to you. See, when you put money in that traditional account, you got a tax deduction for it. And so the government's like, if you want to convert that over to Roth, you got to take it into income and pay tax. So if I had that $100,000 account of traditional dollars, I converted to Roth, I'm going to take $100,000 into income. Whatever IRA custodian you use, whether you use us at Directed IRA or any other company, we're going to send you a 1099 when you convert to Roth. You're going to open a new Roth account. You're going to get a 1099. That goes on your tax return. Now, some people like to do what's called chunking. We do this with a lot of clients that are converting larger accounts that want to hit the tax burden over a certain number of years. So like, for example, at the end of last year, a lot of our clients, we were converting half of their account before December 31st, 2023, and then the other half January of 2024. The reason we do that is we can break it up into 2 tax years, but get the full amount really converted within a 30 to 60 day window there. And so that way, if I had, let's say, a $500,000 account I wanted to convert to Roth, I converted $250K in 2023, $250K in 2024. I got to break up that conversion between 2 years and 2 tax years, which helps you minimize your tax liability and not hit you into a higher tax bracket. So that's, of course, the downside of the Roth conversion. Now, the upside is, let's say you did that with $100K here. I know I'm jumping around in the numbers and examples, but let's say you converted $100,000 from traditional to Roth. Well, I had to take that $100,000 into income. Let's say I'm in a 30% federal tax bracket, 5% state. That's $35,000 of tax I had to pay to convert $100,000. But if I can turn that 100,000 into $1 million over the next 20 years, that $1 million comes out of my Roth IRA to me tax-free. I'm not paying any tax on that $1 million coming out. If I left that as traditional, that 100,000 as traditional, and it grew to $1 million, how much tax am I going to pay to pull that $1 million out at retirement? Well, let's say you're still in a 30% federal and 5% state. $350,000 in taxes. So I'm willing to take the tax on the smaller amount before the growth happens. That's the concept, and why a lot of people like to convert to Roth is they want to grow the account. So that's the benefit, of course, of doing the Roth conversion. But Melissa, as to your question, no limit. Whatever traditional dollars you have, you can convert. Obviously, the more you convert, the more tax you're going to pay. But the upside is that tax-free growth as we go. All right, Tristan's holding the mic. That must mean he has a question. Tristan's here in my studio, by the way, guys. He's the man behind the scenes. He's like the Wizard of Oz here, helping me with the lives. But he also fields your questions. So be nice to Tristan because he might pick your question.
Thanks, Matt. We got a question from YouTube. Brenda wants to know, if I want to dabble in Bitcoin, can I use my traditional or Roth IRA, or do I need a special account?
Okay, great question. You can invest in crypto using a Roth IRA or traditional IRA. What we have is we have a special product at Directed IRA called a crypto IRA. We partnered with Gemini Trust Company and Gemini Exchange, one of the largest providers, one of the few regulated and audited providers in the space, why we picked them many years ago. But you can actually buy crypto with your IRA. So if you have an IRA at TD Ameritrade, they're not going to let you buy crypto. But what you could do is you could move that traditional IRA to a crypto IRA at Directed IRA. We'll drop in the link to our page here. We have some prior webinars and podcasts on this, but you'll get to a crypto IRA at Directed IRA. Now that could be traditional IRA. It could be a Roth IRA, a SEP IRA. You can even do a crypto health savings account or a crypto Coverdell education savings account for your kids. And then that account will then be linked to a crypto trading account with Gemini, where you'll have a wallet and you're on exchange and you can go buy and sell crypto all day long. And so now a lot of our clients just buy and hold, but you could be trading every day if you wanted. So yes, your retirement account can own crypto. The downside is you're not going to do that at your typical broker dealer IRA. They're still trying to get their head around crypto, and are we going to allow people to do it or not? And there's all the SEC regulation and cases out there. We've been pioneering this. I bought Bitcoin. We should link this video in there too. I bought Bitcoin in my retirement account in 2017. I shot a YouTube video on it, so be forgiving on it. It was a while ago when I shot this. But even in the video, it's funny because I'm like, Should you buy Bitcoin in your IRA or 401k? I don't know, but I did it because I wanted to learn about it. And I had lots of clients asking me how they could use their Roth IRA or Roth 401k, particularly to buy crypto. And these were obviously pioneers doing this back in 2017. And I was like, I don't know how to do it. So I went and did it myself. I bought a few Bitcoin. It was $2,500. Even in the video, I talk about, is this worth $2,500? Who knows? But I went ahead and did it. And so one of the great little experiments I had, I must say. And so, but we've been trying to help clients because as an IRA provider ourselves, I mean, you can buy stocks, bonds, or mutual funds with an account with us at Directed IRA. But what most people come to us for is they want to buy non-publicly traded assets. They want to buy real estate in their IRA or 401k. They want to invest in a small business, in a startup, in a private fund, in crypto. You just can't do that at like a TD Ameritrade or a Fidelity, the typical broker-dealer IRA providers. But with a self-directed IRA or a crypto IRA, what we're doing every day at Directed IRA, you can actually buy those types of assets. So we're gonna have more content coming out about the crypto. That's getting hot again now, of course, as Bitcoin, Ethereum, a lot of these crypto assets have been bouncing back in terms of value from the highs they were a couple years ago. There's kind of been the crypto winter, so to speak, and there's been a lot of fraud and regulation, and the whole industry is sorting itself out. But yes, you could dabble in that and buy crypto with your retirement account. All right, let me hit another question. Do you have another live then?
I got another live one.
All right.
Jay, he actually this is a YouTube comment. It's a two-parter. He said, "Hey Matt, love your hair."
Oh, thank you.
That was the first part. His question is, what is the best retirement strategy for a highly compensated W-2 worker with a side gig? Should he do a 401k, Roth 401k, or Roth IRA? The reason he asks is he has a 401k and Roth 401k at work.
Okay. All right. What was his name? Jay?
Jay.
Okay. All right. Great question, Jay. By the way, I got a haircut on Friday and I've been trying some new product in my hair. So appreciate that. Okay. Now the second part of your question, highly compensated W-2 employee with a side gig. You got a lot of options actually. Our general rule of thumb, and every situation is unique, so I'm just going to give you our general rule of thumb, is if you have your day job, your highly compensated W-2, we want you to definitely still be contributing there and getting your match. Most 401ks are going to have a match. A lot of times it's dollar for dollar. You put in $5,000, they put in $5,000. That's like 100% return on investment in day one. So we always like to go get the free match. The benefit of the day job or corporate America 401k where you work is that match. The company's putting in that match on your behalf, which benefits you. And like I said, if it's dollar for dollar or even 50%, sometimes they'll put in 50 cents for every dollar. That's 100% or a 50% return on day one. So we always want to get the match. The next thing we say is go outside the 401k. We call it the match and out. Now, if you have a side gig, and if we think of our buckets of money here, you've got your day job 401k, you've got a side hustle. The next thing I would consider is doing what's called a solo 401k. Now we can get back to here whether you're doing traditional or Roth dollars. That's another consideration. I'm just trying to talk about how do I maximize the contributions in, whether you're doing traditional or Roth. So the first thing is let's max out our 401k at our day job up to the limit where we get the full match that the company offers. Sometimes they don't offer that match all the way down the road. Let's say, for example, your company has a 3% match. And let's say you make $300K a year. Okay, I'm just doing these numbers so I can do the math easy. Well, 3% of $300K is $9,000. So if you put in $9,000 to the 401k, they're going to match $9,000 into the 401k. So that's $18,000 you've put into the 401k. Now you actually could put a lot more into that. You could put more employee contributions into that. Up to, you did 9, you could do up to 22,500. So you have like another 13,500 you could actually put in as just employee contributions. Plus you could do after-tax contributions. There's a lot of strategies here, but just hang with me here. Let's just go get in enough to get the maximum of the match, whatever that is in your situation. Next step we want to do is do a solo 401k in your side gig. If you have net income coming out of the side gig, we like to do a solo 401k. You can put up to $69,000 a year into the solo 401k. Now, stay with me here, everyone, okay? Because this is about maxing out. since you already did 9,000 of employee contributions in the corporate America 401k, we have to subtract that 9K out of your solo K. You can do 69K total in the solo. So now you can only do 60K in the solo. Well, that's still pretty great. Now, the reason I like to do a solo 401k in your own side gig or side hustle is because you have unlimited investment options. See, in your day job 401k, they probably let you buy mutual funds or target date funds. And, those have limited returns that you can expect to get. They might be good for you. You might be really good at picking those. I don't know. But a lot of our clients are like, nah, I'd rather have bigger investment options, whether that's full brokerage trading or self-directed, where I'm actually buying real estate or private companies or startup or crypto or oil and gas or whatever, venture, private equity, whatever non-publicly traded asset you want to do, you can do that in the solo K. So by doing the solo K and the side gig, those buckets of money that I'm putting into, I have greater investment options. Okay. Now on top of that, I do a backdoor Roth IRA. Okay. Why not? Let's get more money into the backdoor Roth IRA. And so, I did last week's live. We talked about the backdoor Roth in particular, but let's add the backdoor Roth in. Okay. And so right there, you've got 3 different account options. Now, another consideration for any W-2 high income earner, let's say you didn't have the side gig. Okay. You're high income earner, you're maxing out at your day job 401k to get the match. And you're like, what else should I do? Well, you could do the backdoor Roth. We can't add in a solo K because you don't have a side gig, but Jay did. So Jay had a lot of options: matching out, solo K for the side gig, backdoor Roth IRA on top of that. So you had a lot of options there. But for those that don't have the side gig but have a high income W-2, you can do what's called an after-tax employee contribution. Most plans allow for this, where you might put in enough to get let's say you put in $22,500. You just max out what you can get into the 401k as an employee. You got some matching. Let's say you got $7,500 in matching from the company. I don't know. I'm just doing it to make the math easier. So you got 30K in. Well, you still have up to 69,000 total that you can throw into a 401k. The problem is your employee contribution is limited at 22.5 and your company won't match anymore. They're not going to throw any more money. Well, how do I get to the 69,000? I only have 30K in. I want to get the full 69. After-tax employee contribution. That's what it's called. So you're going to do an after-tax employee contribution. Now, you don't get a deduction for this. It's called after-tax. What you're allowed to do, and there's a special revenue ruling on this. There's some articles we've done on this in some prior podcast episodes, actually. But what you're allowed to do with an after-tax employee contribution is actually roll it out to a Roth IRA. There's no conversion because you didn't take a deduction, but now this is Roth dollars. Now it's even outside the plan at your day job 401k, and it's in a Roth IRA, which you're self-directing. And so this is a cool little option, this after-tax employee option. Now, if you're the business owner or a high-income earner with employees where you own the business, the strategy doesn't work as well. But even if you're a highly compensated employee in a business, this is a great little strategy to implement. Okay, anything else live? That was a rather complex question, Jay. I hope I didn't lose everybody there, but I love that question because you have options. All right.
We do have one more.
Okay.
This one came from Instagram. This one is, what are the requirements to convert the traditional IRA into a Roth IRA?
Okay. There's no requirements. There's just you got to pay your pound of flesh to the IRS. So there used to be a restriction on high income earners. If you had a certain level of income, the IRS didn't let you convert from traditional to Roth, but Congress got rid of that 10 plus years ago. And so now there's no restriction or qualification to convert from traditional to Roth. The only catch is what I mentioned earlier is when you convert from traditional Roth, you have to take it into your taxable income. Okay, let me hit some of these questions that came in advance as well. All right, this was from Bozer Brett. Says, my only income is a pension, which is taxed. From what I can read, I can't open a Roth because a pension isn't considered earned income. That's correct. So if you do have income from a retirement account, whether that's a pension or 401k that you're starting to draw out, you're over 59 and a half, that's not considered earned income to make new contributions to an IRA or Roth IRA. Same scenario if this was Social Security income coming in. That's not considered earned income. So earned income is going to be like wage income or self-employment income where you're getting 1099 or a small business if you have that. That's going to be considered earned income upon which you can make a Roth IRA contribution. But retirement account income, distributions, Social Security income, that's not earned income upon which you can make a Roth or other retirement account contribution. All right, let's see. STO asked, if I have a self-directed 401k that owns an investment LLC, are you still at risk of a personal judgment forcing the sale of assets held by it? Typical. This is a tricky question. Let me actually go to the whiteboard on this one because I want to explain asset protection for retirement accounts. And this is a tricky area you have to, that sometimes people get confused. When you think of a retirement account, a lot of people think of, well, my retirement account is asset protected. I've always heard that creditors can't go after my retirement account. And that's true. Your personal creditors cannot get into your IRA or 401k. The classic example of this is O.J. Simpson. If everybody remembers the O.J. Simpson story, and we can take the whiteboard off, I'll come back to it in a second. If everyone remembers the O.J. Simpson story, okay, not guilty at his criminal trial, but he was held liable in his civil trial to the Brown family. And so they had like this 30 million plus judgment against O.J. Simpson. And what happened in that case is they were trying to collect on it. And they were able to collect on some things, but one of the biggest assets O.J. Simpson had was a very sizable pension and retirement plan with the NFL as a professional football player. Now, they could never collect on that, and they were restricted from collecting on that. Even when the pension plan paid O.J. Simpson the income and that money was sitting in his bank account, they couldn't attach that either because it was sourced from an asset-protected source. You can even file bankruptcy and you have an IRA or 401k, creditors cannot collect against it, okay? So your IRA or 401k, the government has not only said, hey, we want to give you tax benefits to put money in traditional accounts. We want to let this money grow and come out tax-free in retirement if it's Roth. We're going to let either of those accounts grow and you pay no taxes. It's building and growing. It's not hitting your 1040. Go make money, grow it, reinvest every penny. I mean, the government was like, here's some incentives. In addition, they said, and creditors can't come after your retirement account. Now, this is your individual creditors, okay? Think of O.J. Simpson personally having a judgment against him, or more likely you have a credit card or a loan or a business deal that goes bad, and you get a judgment against you personally. They cannot personally go after your IRA or 401k accounts. Now, there's a couple nuances to that and caveats and except in California and all these examples. I'm going to get to that here. Now, when you start self-directing your IRA or 401k, and let's say you're buying assets, investing in businesses, or buying real estate, the asset protection consideration is different. All right, now let's go to the whiteboard now here. Okay, now this is you here. Forgive me. My penmanship grades in elementary school were N for needs improvement. I never got past an N. So I don't know. I think I peaked in the 3rd grade. So, but this is you here. Okay. You own your IRA. Let's say you're self-directing in your IRA, or as Scusto asked here, your 401k. It's the same thing if you have a solo 401k or a self-directed 401k. Let's say it owns an LLC 100%. This is you. You own your IRA 100%. And then the LLC owns a rental property. That's what this is up here. That's not pie. That's a rental property. So let's say something happens on that rental. Tenant slips and falls. Well, they are forced to sue the LLC. They can't come down after the IRA or to you personally because you don't own the LLC. You don't own the property. Your IRA doesn't own the property. The LLC does. That's one reason people use LLCs and just any rental property or business structure. One of the benefits of an LLC is limited liability protection. That's the L&L in LLC, limited liability. So I'm getting that asset protection where if something happens on the business deals or the rental property or the flip or whatever you're investing into with your self-directed account, they're stuck at the LLC level. They can't come into the IRA's other assets, or they can't come against you personally. Now, what this question that Scusto is asking is actually the opposite. They're asking, what if I get a judgment against me personally? And someone wants to go after my IRA or 401k or get up to the LLC, which owns properties. Now, generally, they are going to be barred here by that retirement account asset protection rule I mentioned earlier. Your IRAs or 401ks are protected from your personal liabilities and your personal judgment. Now, a couple caveats to that is some states restrict IRA protections up to 1 million. Some of them will say, we're not going to let creditors get in there up to $1 million. Most states have an unlimited number on that. So some states have up to $1 million. The one state that has kind of the worst protection is going to be, you guessed it, I know you're thinking it, California. Okay. In California, what they say there is they don't even give a cap on it. Instead, what they say there is your IRA or your IRA in particular is protected from creditors up to the amount necessary to provide for the beneficiary. So it's kind of this subjective analysis is, does the beneficiary have other assets, or is this necessary for the owner of that IRA to live off of, or their spouse or other dependents? And you have to kind of show that, hey, if I have this big judgment against me and they're coming after my IRA, you'd have to, in California court, you'd have to show I really need this to live off of. Now, presumably they'd actually go after all your other easier assets, your brokerage account, your other assets, personal assets, things like that. They'd go after that first. So your IRA is going to be lower on the list of when they're going to come. But in California, you just have that little caveat. Now, I wrote an article on this. I know this is a little geeky. If the IRA was sourced from a rollover 401k in California, you actually get 401k treatment. As a general rule of thumb, 401ks are treated as an unlimited bar, even if in California, where you have unlimited asset protection. You could have a 10 million judgment against you and a 10 million account. They can't get into it. So that's a little primer there on asset protection for retirement accounts. You probably want to consult on that if that wasn't enough, or you got follow-up questions on that. But that's asset protection for your IRA or 401k.
All right, Matt, we got one from Instagram. Anna K wants to know, can I do flips in my Roth IRA?
Okay, yes. Okay, your IRA could flip a property, and we love that. But what I would say is that example I was showing there with your IRA owning an LLC and a rental property, I would use that same structure there. Use that LLC to flip the properties, to buy it, to pay contractors to rehab it. And so like my IRA has owned rental properties. My IRA is invested into private companies. My IRA lends other investors money. It's like acts as a hard money lender, and I get 12% interest in 2 points when I lend the money on other people's deals that are trying to raise money to do a flip. But your IRA could own the flip itself. Now, there's a couple things you need to know if you want to do that. First, if you've never heard of a self-directed IRA, we have a podcast. I wrote the #1 book on it, the Self-Directed IRA Handbook. Where is it? It's here, but you can find it. We'll drop the link in there if people are like, I don't know what you guys are talking about, self-directed IRAs. Okay, your IRA doesn't have to just buy stocks, bonds, or mutual funds. You can move your IRA from Fidelity, TD Ameritrade, or a broker-dealer that limits you to that, to a self-directed IRA at our company, Directed IRA. There's 20 other businesses that do this. We just happen to be the best. So you move your account to Directed IRA, and then we'll let your account invest in real estate. It can invest in a small business, in a private fund. It can do private money lending. It can invest in crypto. These are all assets your IRA can own. Now, that IRA can own an LLC, as I showed in that diagram a moment ago. That LLC could do the deals. And so you're the manager of the LLC. You don't own it. Your IRA owns this LLC 100%. It'll put cash into that LLC. That LLC will have a business checking account that you'll have access to because you're manager of the LLC. And then you can go flip the properties in the LLC. Now, you've got to follow the rules there. Make sure you get a consult. Our lawyers set these up every day, working with Directed IRA, my law firm, KKOS Lawyers. We're helping clients every day do this and do it properly. It's not rocket science. You just it's like a board game. You just need to read the rules before you start playing the game. Now, the second thing to know, though, that's unique to flipping properties is what the government said with retirement accounts is when Congress created it was, we want your IRA or 401k to receive investment income. When your IRA or 401k receives investment income, you don't pay any tax. But If your IRA or 401k receives business income, then you have to start paying a tax on the retirement account's earnings, which is called unrelated business income tax, UBIT. Sometimes it's called unrelated business taxable income. There's a whole chapter in my book on this and exemptions and ways around it and strategies. But when you're flipping properties, one of the rules of thumb is if you're flipping 1 or 2 properties a year in your IRA or 401k, we're not worried about this UBIT tax. That's going to be deemed investment activity. But if your IRA or 401k is flipping 5 properties a year or like a property a month, the IRS could look at your account and say, your IRA or 401k is really in the business of buying and selling real estate, where it's not holding them for an investment long-term. You're doing too many short-term deals. And because of that, it's in the business of real estate, not investing in real estate. If you're in the business of real estate, that's when that unrelated business income tax applies. And that's a 37% tax. It's kind of a nasty tax. Your IRA has to pay it. So we want to avoid that. If you're flipping 1 or 2 properties a year, you're good. Even your spouse could be flipping 1 or 2 properties. You're in their account. You could be flipping 1 or 2 properties in your Roth IRA, 1 or 2 properties in your solo K. And you could be doing multiple. You guys could be doing, 6 deals there between your account, your spouse's account, and your solo K. So there's a way for those of you that flip a lot of houses, you want to maximize this to do it with multiple accounts. But absolutely, you could flip a property in your retirement account every day. I'd probably say every day we have someone doing that here at Directed IRA. We open 25 to 30 new accounts a day. 60% of those accounts are doing some form of a real estate deal, whether it's a rental property, a flip, private money lending, investing into a syndication or a fund that's doing multifamily or commercial real estate. I mean, it's just super popular. Real estate as a general category, and all the strategies are there, from flips to buy and hold rentals to single family to multifamily, commercial. We've had clients to buy water rights. I mean, these options are all out there on the table. Okay, let me hit some of these questions that came in advance. Unless we got any live, they get priority. But all right, Christian Aon asked, Christian Aon asked, are collectibles permissible for purchase in a self-directed IRA or IRA LLC, such as art or classic cars? No. There are only a few restrictions on what your IRA or 401k cannot own. The only restrictions are collectibles, life insurance, and S corporation stock. Christian, you have hit the number 1 restriction here, which is collectible items. So art and collectible cars fall into the definition the code has in the Internal Revenue Code for collectible items. So your self-directed IRA can't buy them, nor could your IRA LLC. Your IRA LLC is still subject to all the rules for retirement account assets. So by doing an IRA LLC, I'm not getting around any rules. I'm still going to have to comply with that collectible rule. Now, there are some exceptions to collectibles. Precious metals, for example, there's an exception there for precious metals. Gold, silver, platinum, and palladium are the 4 precious metals you could buy. Sometimes coins can be considered collectibles, gold coins, silver coins, for example. But those 4 categories of precious metals, gold, silver, platinum, and palladium, are exempt from the collectible rule. There's a certain purity and fineness requirement that the precious metals have to meet, and you can't store it at your home. But you could buy precious metals. That's not deemed a collectible. The other area where we've seen collectibles be an issue is in the crypto space. We definitely have clients buying and selling crypto, like let's say Bitcoin or Ethereum or Solana. You can buy those types of cryptocurrencies, but you can't buy an NFT that is essentially digital art. If you're buying an NFT that is basically just has collectible value in and of itself, there's no utility value to the NFT, that will also fall under the collectible rule here. So your IRA or 401k could not own it. All right, Christian Aon asked a great question, said, hi, new to the channel. Can anyone tell me if the new FinCEN regulation also applies to IRA LLCs? I have another video on my channel about this new rule and this new federal agency that's going to apply to all of you LLC owners called FinCEN. Basically, anyone who has an LLC or corporation, not basically, everyone who has an LLC or corporation needs to know about this new FinCEN rule and the beneficial owner information report. You have to make a filing of your existing LLC, or now for any new LLCs, to the federal government saying who owns this. It includes updating an ID, the address of any owner of 25% or more, and anyone that has substantial control, president of the corporation, manager of an LLC. That has to all be disclosed now to this federal government agency. Now, I've done some lives on this. There's a federal case in Alabama that this has been ruled unconstitutional, but it only applies to those specific plaintiffs in the case. Everyone else still has to comply. So there's other resources on that. We'll drop that into the chats here to make sure everybody knows about that. As to Christian's question about an IRA LLC, do you have to comply? Yes. And what they want to know really is who is the underlying owner of the IRA LLC. Well, if you think of the IRA LLC, if you're the manager, you have substantial control, so you need to be disclosed on this BOI report. And then also, if your IRA owns the LLC more than 25%, a lot of people's IRA LLC, their IRA owns the LLC 100%. They want to know who's the underlying owner of that. They don't want to know Directed Trust Company or your IRA company. They want to know whose account it is, who's the underlying beneficial owner of the account. Well, you're the beneficiary of your account during your lifetime, while you're alive. When you pass away, it passes to your spouse or your loved ones or charity or whoever you've designated. But during your life, you're the beneficiary. That's who they want disclosure on, who's the underlying owner. So yes, this FinCEN rule will apply to everyone with an IRA LLC as well. We've put out a lot of resources on that to get people aware. We have a company called Main Street Business Services. That's a company my law firm partner, Mark Kohler, and I set up, mainstreetbusinessservices.com. We'll drop the link in there, where we do your company compliance, we do your state renewal, we do your annual minutes, and we do your FinCEN registration and any amendments or updates that need to be made there as well. All right, we got a live question, Kristen?
It's not a question. It's just showing some love here. Brenda says she wants to throw a shout out to Directed IRA and KQS Lawyers. She's super happy with both and appreciates everyone.
Ooh, thank you so much, Brenda. Appreciate that. You guys could be like Brenda and use Directed IRA if you want. We're here for you. I want to just give you great information too. It's not to be promotional, but we are the best. So check us out. Give us a shot if you're in the self-directed space. If you're using someone else, you can come to us. Or if you're new to the space, keep tuning in. We're going to be creating a lot of educational stuff. We have webinars. We have our self-directed IRA summit, by the way. That is April 20th in Dallas, Texas, sdirasummit.com. It's a full-day educational event on how to use your IRA to invest in real estate, private companies, private funds. That's what the self-directed IRA, if that means. And it's an awesome opportunity to meet other people that do that. Not only is there lawyers and CPAs and other professionals there, but there's experienced self-directed investors with $1 million plus accounts that talk about the stuff they've done to use and build their self-directed retirement. All right, let's jump back into some of the questions that came in advance. Let's see. This is from Cinda Murphy Real Estate. Cinda asked, I had a 401k. After I quit, I rolled it into an IRA. Can I turn that into a self-directed IRA now? I'm a realtor now, and I want to start investing all of that money into real estate instead of the stock market. Absolutely, Cinda. That's definitely what you can do. So if you had an old employer 401k, you can always roll that over to an IRA, which you've already done. That might be like at a broker dealer, let's say Fidelity here. But the problem for Cinda and everyone else is if you call up Fidelity and you say, hey, I've got an IRA, I want to go buy the rental property on 123 Green Street, they're going to say you can't do that. And that's not because IRAs can't own real estate. That's because Fidelity IRAs can't own real estate. Okay. So what you'll need to do is move that account from Fidelity to a company like ours, Directed IRA. Now, when you have an account with us, and by the way, there's no tax, there's no penalty. It's like going Fidelity to TD Ameritrade, Charles Schwab to LPL Financial, your local bank to a credit union IRA. You're just changing the provider of the IRA account. And you can move the whole amount. You can do a partial amount. You can leave some on the stock market and roll over another piece to do real estate or other self-directed assets. So you have a lot of options there on how to do it, but there's no tax or penalty. When it's at a self-directed IRA, at Directed IRA, it's just a traditional IRA or a Roth IRA, whatever account type you had. Okay, so it's still a qualified retirement account. No tax or penalty to do it. But now you're able to go invest in real estate. And our mantra has always been invest in what you know. If you're a realtor, Cinda, and you know real estate, you already know you want to invest in that, not the stock market. You should invest in what you know and where you have a competitive advantage, where you're spending your time and effort and building your knowledge. I want people to know your IRA or 401k is not just restricted to Wall Street. There's so many real estate investors out there and people in the real estate space in particular that know real estate and never knew their IRA or 401k could invest in it. Meanwhile, they've just been putting money over here going into mutual funds and stocks they don't even know. They couldn't even tell you the name of it. And so, yes, this is absolutely an option for you, Cinda. You can get over at Directed IRA. Some of our team there, of course, can help in answering any questions and setting up your account.
Okay,
All
we
right,
got a
live.
question on YouTube. Bucks03 fan says, if my mother opened up a Roth IRA, can she put one of her children as beneficiary?
Yes. So great question, Buck. So when an account is set up, you have a number of options to list as beneficiary. You can list a spouse as a beneficiary. Now, this is a little important little legal tip here. I'm a lawyer too, so I can, field these legal questions here. If you have a spouse, you typically need to list your spouse unless you have otherwise provided other assets for them, or you have a prenuptial agreement or something like that, separating out the assets. If you list someone else besides your spouse on the account, like your kids, and you're trying to bypass your spouse, you can do that. And a lot of people do that. There's a lot of good reasons to do that. For example, you have a large estate, or you just want your kids to receive the retirement accounts, to do stretch accounts or things like that, stretch IRAs, because they get a 10-year window to continue investing it and it to be tax deferred. But there are state laws that have some restrictions on that, on not listing a spouse if you have one. So I'm just throwing that out there in this example. But let's say that your mother doesn't have a spouse, or a spouse has predeceased them. They can list the kids as the beneficiary, or one of the children as beneficiary, on the account document. Now, retirement accounts pass on what's called POD, payable upon death, or transferable upon death, TOD sometimes. And a lot of retirement accounts, bank accounts, life insurance passes this way. Whoever is listed on the beneficiary form, regardless of what you put in a will or in your trust, that does not control. What is listed on the beneficiary account designation is what controls. So you've got to make sure your beneficiary designations are up to date. But yes, absolutely, you could list, your mom could list a child as the beneficiary upon her death. Now, what happens when the child receives the account, they can get what's called an inherited IRA, or a beneficiary IRA. And that account can still stay an IRA and stay invested for another 10-year window, where you don't pay any taxes, you continue to defer or continue to get a tax-free growth if it's a Roth account, and then it gets distributed out at the end of 10 years. So that's called an inherited IRA, by the way, or beneficiary IRA. We have some articles or other podcasts on that as well to learn more. But absolutely, child could be listed as beneficiary. Now, if a spouse is listed, one of the nice things about a spouse is, if you have one, the surviving spouse inherits the account as their own IRA. There's no 10-year rule. It just becomes an IRA in their name, and they can continue investing it however they want. Tax-free growth continues if it's Roth forever. It's not a 10-year window like it does if it goes to a child or any other non-spouse beneficiary. All right, do we have another live question?
Yeah, this one's not much of a question. I'm not sure. Maybe you can just give him some resources. I don't think you can really answer this, but DJK Investor on Instagram says, what are you seeing in Phoenix, Arizona as the highest and best returns? Can you disclose that?
Phoenix as the highest and best returns.
Phoenix.
I mean, the hard thing with that is, if you look at our largest accounts here at Directed IRA, and I do every once in a while, I'm peering into them, seeing what they're doing. I just helped one of our actually largest account this morning on a transaction. They're all doing different things. What is that client doing right now? Investing into a private company. That's what he does. He invests in startups and venture investments. Sometimes he goes to zero. Sometimes he gets 100x plus return on them. But he's done that for 20 years. Okay. So it's not like there's one thing. Like we have accounts that are doing real estate deals, and they can have a 10x return. But I see other people make barely 5%, or sometimes people lose money. The same thing can be said for the stock market. So there's not a thing that makes more money than something else. It's about somebody finding a strategy that they're good at to pick the winners from the losers. So and that's why we say invest in what you know. If I looked at all the big accounts over here, they're not all doing the same thing. I'd say the other largest accounts we have are doing real estate transactions. I have a lot of accounts, 10 million plus here, that $10 million plus in a retirement account. And I'd say the majority of them are doing real estate in some form or fashion. I have some of them just doing private money lending. That's very, very common in our large accounts. They're just doing private money lending, getting 12% interest in 2 points, which is what I'm doing. A lot of them are doing just buy and hold real estate. They're buying good properties. They're appreciating over time. They're getting good cash flow on them. So in Phoenix right now, I mean, I'm not an expert in terms of what to invest in. I've just stuck in my lane. My own account does more real estate than anything else. That's just because what I know. I'm better at picking the winners and losers there than I am in the stock market. And so I feel like I just have a competitive advantage and I get a higher yield. And I've been successful at that, even just doing single family rentals. But I'm in Phoenix. I have not been buying single family rentals in Phoenix. You can make money on single family rentals in Phoenix. That's just not where I've been buying. I've been trying to buy cash flow markets for my own rentals because Phoenix is a tough cash flow market. It's got high pricing. Values are still pretty high here. Maybe they go up more over time and it's an appreciation play. I don't know. But that's what I would say. Now, if you're like, well, I don't know how to invest in real estate. Well, what are you doing to learn? Are you going to conferences? Are you going to your local RIA? Are you joining groups like Pace Morby's Sub 2 group? Are you learning from other real estate investors? Like, are you listening to every Bigger Pockets episode? Like, what are you doing? If you're in the real estate space already as a real estate agent, you already know those places. Are you making the connections? Are you going to learn? That's where you're going to find good real estate deals. Are you going to find it tomorrow? No. But over time, you start developing contacts and knowledge. If we're like, well, I want to invest in startups or private companies, are you going to the angel investing clubs? Are you going to all those places where those people meet and talk about deals and source deals? Like at our Alt Asset Summit, we had someone that runs a angel investing and venture group, Tech Coast Angels, out of Southern California. They have a lot of different chapters. There's some in Arizona, Desert Angels, that like to invest in startups. Now, what they tell you is you need to invest in 10 because 9 out of 10 of them are going to fail, but one could be really big. One could be the next Uber, and you just don't know. And so there's lots of different theories. Everybody's better at something else. But at the end of the day, you have to know, am I better at picking the winners and losers in real estate versus venture versus private equity? And there's different risk tolerances to those things too. So that's a tough question to answer. Hopefully that helps. One good resource I would say is our Alt Asset Summit. We do that once a year. The next one will be here in Phoenix, actually in October. The last one was in Southern California. If you go to altassetsummit.com, it was 2 days of people talking about different asset categories and where they're investing and finding success. And that's recorded, so you can catch the last one. Also, you can sign up to be notified on the new one that'll be coming up in October. So hopefully that helps. I wish there was an easy answer, but let's be real. There's just not an easy answer. If it was, everyone would be doing that. Or I wouldn't be here talking to you because I'd just be investing in that one easy thing that we know every day you can just make money at. Now, what I will say is don't be discouraged because of that. A lot of people hear an answer and they're like, well, man, I'm not going to do anything then because I don't know the home run investment to make. Guys, at least get your money saved and invested and do something like the S&P 500. Peter Mallouk, Tony Robbins, Warren Buffett, some of the smartest people on finance and where to invest say, if you don't know, just buy the S&P 500. And in fact, most hedge funds can't even beat the S&P 500 fund. Okay. This is VOO for Vanguard and the fund side of things, or the ETF is SPY, SPY. I'm not an advisor. I'm just saying this is just what general people out there will tell you that are smart on financial stuff. You at least get an 8% annual return over time, if you take a look at this over time, to grow your money. At an 8% annual return, I'm doubling my money every 9 years. Okay. You're saving, and I'm at least doubling my account every 9 years. And so that's better than doing nothing. Now, once you've done that, you've saved or you've put your money aside and you're investing in something, and you could be doing other funds or stocks. I don't know. You might be good at that, but you might just be getting an 8%. You're like, Matt, I want to make a 12% or a 15% return or a 20 or 100% return. Well, that's all the self-directing stuff. That's investing what you know, finding what you're good at, and then just nailing that investment over and over again, picking the winners over the losers. Tristan.
You ready for one?
Yes.
All right. Gianni from...
I think Tristan looked at me. He's like, are you done yet? Because guys, I've been an attorney, like I just said now, for almost 20 years. So, and I billed by the hour for 10 years of that. So I learned how to talk forever. Sue me,
Well, perfect, because we got an attorney asking a question right now.
Okay. We only got 9 minutes left. So this could be dangerous. It's the last question.
Gianni said, tax filing is married filing separately because of my student loan. I'm also a Phoenix attorney. Wife and I contribute to 401k and get employer match. Should we max out 401k before Roth IRA?
Okay, great question. It depends. And as an attorney, I know you can appreciate that answer. It depends on what you want to do with the money. If you're like, you know what, we're just buying mutual funds or ETFs or target date funds, then just continue putting more money into the 401k even after you've got the match. However, if you're like, you know what, I want to do this self-directing, I want to start investing in alternative assets, I would do the backdoor Roth IRA. Because you're maxing out retirement accounts or looking to do it, you're higher income and you're actually filing separate. So you're going to phase out a lot faster to do a regular Roth IRA. You're probably going to need to do a backdoor Roth IRA. In the backdoor Roth IRA, you could each be making annual contributions to it, which, by the way, you can still make for 2023. So your 2023 IRA contributions are due by April 15th. That does not include extensions, by the way. You do not get to extend your return and extend your 2023 contribution deadline. Okay, but for 2023, we can throw $6,500 in as a backdoor Roth IRA contribution, so you still got time to throw that in. Plus, for 2024 right now, you could put $7,000 in. That's $13,500 each of you could put in to a backdoor Roth IRA. And you got to do the steps here and do this before April 15th to get the $6,500 in for 2023. So between the two of you, you could each do this strategy and have $27,000 of new Roth dollars in those accounts. Now, you might just be like, for the first year or so, we don't have enough to do a self-directed investment. Maybe you just invest it in the S&P 500. Like I said, you can even do that at Directed IRA or put it in some fund or stock or whatever you're into or believe in before you're ready to make a self-directed investment. It took me 3 years of contributions before I made my first self-directed investment. Before I bought my first real estate deal, I was in the market for a few years because I need to get a few years of contributions in to have enough to go do a deal. Now, some of our deal-making clients, they can take $5,000 and go turn it around. They wholesale a property, they do transactional lending, or that, they do an option on a property that gives them 100% return or more. Those things you can do. That's just not me. And so it took me a few years to build up contributions to just do a regular. I bought a rental property and I got a loan in addition to it. I bought a rental. That was my first deal. Then I private lent the money. Okay. What else we got?
All right. We got another question from a fellow Matt. When using your IRA to purchase real estate, what's the typical loan to value ratio banks require for a non-recourse loan?
Okay. Great. Excuse me. Great question, Matt. I presume this is Matt with 2 T's. Okay. All right. So generally the rule of thumb for a non-recourse loan is 30 to 40% down. If you go to directedira.com on our resource guide, we have a number of banks listed there that like to do non-recourse loans to IRAs or IRLCs buying rental properties. So generally 30 to 40% down. I've actually got non-recourse loans myself to buy real estate with my retirement account. I actually put about 40% down on it just because I had the cash and it made sense for me to do it. So look for 30 to 40% down. Now, there's one little caveat as you're shopping those to know is some of them will also say, and you need to have 10% in reserves. So for example, if they loan you $150,000, they also want you to have $15,000 left in your IRA or IRLC available just to cover any unexpected expenses or a tenant moving out or an AC unit going bad. They want to make sure you have enough coverage there to keep the loan in good standing. So 30, 40% down is kind of the rule of thumb that I see there. Just watch out. Some of them do have a 10% addition based on the loan value that you need to have available. But that could be in a TD Ameritrade IRA in your name, in the stock market. That it doesn't have to be that self-directed IRA or IRLC. It needs to be an account in your name because it needs to be able to get rolled over or transferred over if you need it. But it doesn't have to be in that exact account. A lot of them will let you satisfy that requirement from another account. All right. Well, we're into the final minutes here. Just a reminder, everybody, we go live every Monday at noon here on YouTube. We put on all those social channels and, of course, in our private Facebook group, the Team Wealth Building Group. Make sure you get over and join Team Wealth Building Group. This is a community I'm starting to build to start helping people learn to build wealth in a community team environment. I'm just providing a ton of free education and resources on how to do it. We're going to have wealth building plans in there, challenges, a lot of cool things we'll be rolling out here in the next couple months. But it's just going to be a community of like-minded people learning to build wealth together, answer each other's questions, challenging each other, kind of like how you go to a gym in a group fitness class, and you want to beat the guy next to you, or you just want that camaraderie of the team. That's what we're trying to build there at Team Wealth Building. So get subscribed on the YouTube channel and join the private Facebook group. We're going to be providing notices and everything about when we're going live and content going out there as well. And then the other thing I'll say just in terms of events, the Self-Directed IRA Summit, again, April 20th in Dallas, Texas. You can also just attend virtually. If you don't want to come live, we stream it virtually for everyone across the country. That's sdirasummit.com, sdirasummit.com. And we'd love to see any of you guys there. And unless there's any final questions, I'm going to be signing off. Okay. All right. Well, thanks everybody for joining us. We'll be back, of course, next Monday at noon for another Matt Sorensen Wealth Building Live. And until then, stay calm, self-direct on. We'll see you then.